trading at its best.
Let's go ahead and introduce myself for those of you that this is their first time coming to one of these webinars. I'm Mike Swanson, founder of TradeWest Forex, Momentix. You've probably seen a lot of the stuff we've talked about if you've been following us over the last few months or years. So what we do with these weekly webinars, as you probably noticed, is we send out a blog post about the topic, and then we cover it in more detail in the webinar. So today's webinar is going to be about currency correlation, what it is, how it works, and try to take a simple approach to it so that nobody's confused, because I know a lot of stuff out there makes it hard to understand and implement. So, but if there is something that I talk about that you're not sure about, definitely make sure you use the questions box and ask questions. That's a big benefit of coming to these webinars, is being able to use that chat box and get the help that you need here. So we're going to talk about how it's calculated between pairs. You know, there's some people that look at currency correlation on an individual currency basis, and others use it for currency strength. So they break the currencies up and look at the strengths, which we might talk more about that in next week's session. We might do that. That might be the topic for next week, is currency strength. But we're going to be looking at the correlation between actual pairs and why it's important to your trading plan. So it's going to be very simple. You'll see that at the end of this, it only takes a quick glance at something or just remembering a few things that you might want to take notes on, and it can make a big difference. So we will also be talking about some strategies you can use based on correlation. And these we did not post on the blog. So that's going to be all new stuff we'll talk about today as well. So let me go ahead and let's see here. Let me switch this over to another page here. First, I'm going to show you where you can get this information. Where can you get the correlation information? So let me bring up a web page. Best thing to do here will be to just go to our blog, tradewestforex.com/blog. As you can see here, if you go to the "What is currency correlation" post, or you could even type in the search correlation on our site here, and bring up this post from yesterday. And on here, we post the correlation table. There's the link to it right there. So if we click that, this takes us over to a website that already does all the work of making the calculations and finding the coefficients. So let me go ahead and explain what's going on here. First of all, you can go in here and specify the pairs that you want to compare. So, you know, you might want to pick all of the different pairs that you plan on really trading at any given time. So, you know, by default, it's selecting pretty much the majors. You might come in here and find that, you know, maybe you trade the pound yen, or, you know, maybe you also trade the euro pound. So, you know, you can select more of these pairs, hit submit query, and it'll refresh everything with all those pairs that you trade. Or if there's some that you don't trade, maybe you take them off. Now they've got this period setting here, and if you hover over this question mark, or you can click it, they can give you some information of what that all means. But basically they're looking at, this is how many bars, 5 minute, if you're looking at this table, 5 minute, hourly, daily, weekly, that's how many periods, or how many bars, if you're looking at a chart, that they are looking back and getting this information. So on a 5 minute, they're going back 50 periods, so they're going back 250 minutes and finding out what the correlation was between each of these pairs. So you see Australia dollar against Australia dollar, of course, is 100%. Obviously, that's always going to be 100%. But then you see Australia dollar versus euro pound, and you start seeing these numbers, 5.7. against the euro yen, negative 54.1. So what do all those numbers mean? Well, these numbers will range from negative 100 I don't think it'll ever really be negative 100, but it's from negative 100 to a positive 100. And the higher the number, the closer it is to positive 100, the more likely the pairs are to move it in the same exact direction at the same time, so that they're going to follow each other. Whereas if it is closer to negative 100, then that means the pairs will mirror each other. They will move in opposite directions. So they will. That's what you're looking at here. So if you want to find a high correlation where pairs are moving the same direction or exactly the opposite, you'll see that they color these numbers. So if it's colored red, it's those are more likely to move in opposite directions, and the closer it gets to be colored green, they go blue and they go up to green. When it's green, that's a high chance of the markets or those two pairs that are comparing to go in the same direction. So does that make sense to everybody? So if you're looking at pound yen against the US yen, the correlation between those two is 85.8%, or 85.8. I guess it's really not a percentage. 85.8. Okay, so what that means is that these pairs, if the pound yen moves up, you can pretty much expect the US yen to move up at the exact same time, or at least over the 50 periods. It's averaging that they're both moving almost the same amount in the same direction. Okay, now but if we look at, and this is just on the 5-minute, I'll explain which one of these you would most likely want to use in your trading. The other one that's at an extreme level is there's a couple of negative 80. So the pound versus the euro pound, those are moving opposite of each other, and you can see that there. So now the 5-minute, you're probably not going to pay much attention to this one unless you are really extremely, scalping in and getting out of trades in less than 30 minutes, about, a little less than half maybe a little more than half the period that you specified here. So that's when you would use the 5 minutes. So most probably aren't going to be paying attention to that one. Whereas the hourly, that might be more what a day trader would be looking at. See what the kind of the short to medium term correlation has been for the last 2 days is what this is measuring. And sometimes you'll also look at the daily. The daily is going to give you the big picture. It's going to show you that in the last few months, last about 2 months it's been, here's what the correlations have been like. And then weekly, same thing. That might be more for swing traders that are holding positions long term. So that's how you use these time frames. You're mostly going to focus on hourly and daily. Most traders are going to be looking at those two. So if we look at these now, let's just look at the daily. Okay, you can see that the pound versus the US franc is negative 90. Very negative, very good chance that these two pairs are going to move opposite of each other. And for the euro versus the US franc, again, that one's one of the highest. It usually has always been the highest, even long term. If you look at the weekly correlation, it seems to always be extremely negative, which causes those to move opposite. And then for the positive side, you can see that euro yen versus euro pound, really high. You can see a couple of these that are really close to almost 100%, 98.5, and that kind of carries down to the daily as well. So now you get an idea of what all these numbers mean. If one of them's, if they come up really negative, you know that means their pairs are going to move opposite of each other. If they come out really positive, they're going to move in the same direction. Now, what numbers do we really care about? What I've found is you really want to see usually above 85, 85 or below negative 85, because anything else is still kind of, there's just a lot of periods where it doesn't move in the same direction and it can throw things off and it just isn't very valuable. If you're hitting 85 or above 90%, that's when you start to see the value in this. And let me show you how this would work. So I'm going to show you how we can use this as a filter for taking trades. What we would do is, let's say I've got the euro-dollar, I've got a euro-dollar chart up, and I've got a euro pound chart up, and I'm trying to decide if I should, both of these are giving me a signal to trade. I'm trying to decide if I should take them both at the same time. You probably see this all the time. You've got your indicators set up, and maybe you got a whole bunch of pairs you're looking at, and you start to see signals from almost all of them at the same time, or right around the same time. So you start jumping in a bunch of trades. And then what happens? Well, a few of these, you notice that when one starts to lose, it pulls the others down and causes the others to lose. Or same thing, maybe one's winning and the other's winning. That's always the best case is if they're all moving in profit. But if that's what's happening, it could be because they're highly correlated or negatively correlated, depending on the direction you're taking the trades. So, like I say, it's only a good thing if the trades are moving in profit. Otherwise, if they end up losing, all you've done is just increased your exposure in the market. So if I go back to this example, if I was going to go long euro dollar and then I had a signal to short the euro pound, since they're negatively correlated, all I've basically done is doubled my risk, because what most likely is going to happen is if the euro dollar goes up and I'm buying, or let's say it goes down, so if I'm buying and it goes down and I've sold the euro pound, this is telling us that most likely the euro pound is going to go up. So I'm going to lose on both these trades. And so that's why you wouldn't want to trade these pairs at the exact same time. So that's how we can use it as a filter. Is if one of them's given us a signal, try to pick the one that looks the best. Usually with systems you can determine which one looks better or is in a better position or is giving you a better risk to reward ratio, any kind of thing like that. And that you look at those things and then make your decision based on that, on which pair you're going to trade. But you wouldn't want to take both in this case, especially against the U.S. franc. On the hourly, the last 2 days these have been extremely negatively correlated. So when the euro moves up, U.S. franc moves down. So you would not want to trade these at the same time. And you wouldn't want to trade them in the same direction, because then what you're doing is basically hedging. I'm going to go to some charts here in a minute, and hopefully that'll help put this together and make more sense if you're not quite following yet. But this is really important, like I say, because you don't want to. If you're going to double your risk on a trade, it'd be probably better to cut your risk in half and then trade both of them. But you're going to see when I go to the chart why when there's these highly positive or extremely negative values of correlation coefficients, you don't want to be trading these pairs at the same time. Instead, look at how many in here actually have numbers that are kind of just in the middle, in the 70s, in the around 0, where there's just almost no correlation. When you get to 0, it means they're almost completely independent of each other. So U.S. franc and New Zealand dollar, those do really well together. Even New Zealand pound yen, there's plenty of combinations. So it's not like you're going to be limited too much by trading multiple pairs. So let's do this. Let's do some comparisons. We'll come back to this in a minute, but let's just go look at that euro dollar versus the U.S. franc at negative 99.2 on the hourly, negative 94.1 on daily, and even negative 85 on the weekly. So it's just really strong negative correlation. So we should expect to see these moving opposite directions. So let's go bring up some charts. And we'll take a look at this. Okay. Okay, so I've got a U.S. franc chart. Let's give me 1 minute here and I'll show you guys. We're just going to stack these up so we can see them side by side. So there's my U.S. franc, and let's get a euro-dollar chart. 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 Euro-dollar ch Okay. So what we're going to have to do here, since this one was correlated all the way down to the 5-minute. But what I'm going to look at is I'm going to go to a 15-minute chart. That'll pretty much reflect what we're seeing on that hourly correlation table for the number of bars we're really looking at, since that's measuring 2 days. So here's your last 2 days. Do you guys see how they are mirroring each other? That highly negative correlation is causing these pairs to move pretty much the exact opposite direction. I mean, you can point this out right here. I've got these both lined right up, so I can, I can see that when that moved up on the euro dollar or U.S. franc, the euro dollar moved down. Okay, so you can see bearish candle, bullish. Up here we have the bullish candle, bearish. It's not every single bar is going to be different, and not every tiny little move is going to be the same, but it's going to be very close, because we're looking at a table that is measuring the last 50 1-hour bars, basically, or 50 hours. So that's pretty much the last 2 days. And so if we look at that, you can see very clearly how, let's go back to, like I was saying, if you were deciding, let's say you had a signal on, let's get a little shape up here. Okay, so if you've got a signal to sell, let's say you've got a signal to sell after this big move up right here, maybe it starts to turn down, and you've got a signal to sell right up there on that bar, most likely your system's also going to give you a signal to buy. If your system's designed to work the same on different pairs, you're going to see a signal to buy right there. You know, they both had a big move, they started to turn. This one had a big move, started to turn. That's what your systems are probably going to do. And if that happens, if one says to sell, one says to buy, and it doesn't have to be that way, I guess. It could be, this could come in later. This one might not even say to sell over here. But either way, if you're buying on this one and selling here, what are you doing? What's going to happen? Well, if you're selling right here and the market moves up against you, and you're right over here before that move up, you're down 28 pips. And then look over here. You bought here, at that same time, you're down 40 pips. You're losing on both trades. Do you see why that's important? Because if you're taking both these trades at the same time, like I'm showing you here, when this move takes off, you're losing on both sides. So this pair is not helping you. They're not helping each other at all. And it's a very simple concept that you can apply with your trading. You'll see when I'm going to show you some that you would want to trade together and how they can actually complement each other. Instead of causing you to either lose twice as much or hedge, think about if I flipped this. If we sold both of them, if I sold both of them, all that means is one's going to make money and one's going to lose money. So they're going to cancel each other out, and then you've just wasted your time taking these trades. It's like trading the same pair opposite of each other, just a complete hedge with just a slight, because they're not 100% correlated. We were seeing 94 to 99, so there might be a slight difference, but not enough to really make it worth it. Okay, so someone says, why not buy U.S. franc and sell euro dollar? Well, we did just I can flip that around and show you the same thing. So you're saying buy U.S. franc, sell euro dollar. Okay. If you sold euro dollar here and bought euro dollar here, then this is like I said. There are going to be times where it's great because both of them are going to make money here, but not always are you going to be right. And when you're wrong, you're getting hurt twice as bad. And like I say, if you trade them at the same time in the same direction, you're hedging. So let me just tell you this. This is the way you can look at it. If you really wanted to do this, why wouldn't you just buy twice on the euro? Just increase your leverage on there. Why would you even add the U.S. franc, right? If you're looking at it that way. Now I've made the same amount of money. I didn't even need to mess with trading another pair and watching it, or waiting for a signal on the other negatively correlated pair. So that's the way I look at it. Now, like I say, they don't really work well together at the same time. The only time maybe it would make sense is if you're going to day trade, say maybe you're going to trade the 15-minute U.S. franc and then you're going to be on the 4-hour on the euro dollar. Then that's a whole different story, because you have a buy trade here, you might get out of in a few hours, and your 4-hour you might be in it for 2 days. That's fine. That's when that's usually the only times I will trade these kind of pairs together, is when I know it's just a short-term correlation for me, and then I'm going to be out of one of them. Okay. Well, let's do this. Let's go back to that table and let's look at some that actually work together. And I'll show you the difference and why this is better setup. Okay, so here we go. Let's take a look at, okay, let's see. Let's go find something. Let's go find these ones that are actually really close to zero. So U.S. franc against New Zealand dollar. Let's go take a look at those. Okay. So I'm going to switch this euro dollar over to the New Zealand dollar. Okay, now do you see, let's go back to the 15-minute. Now do you see how these are not moving really the same at all? Yeah, right here they moved opposite, but look how much further the New Zealand dollar continued, where the euro dollar just kind of went flat. So that's a big difference. Let me just show you an example now of this with these pairs together. Let's say you sold here and you were wrong because the market went up. Well, if you sold here, instead of it being a hedge, it turned out to be more than a hedge. It protected you, but also gave you a profit on this move down, right? If you look what happened here, the euro dollar jumped up, whereas the New Zealand dollar went down and continued down. So let's say you get stopped out. You're out of the trade right there, or maybe even at the top. Okay, so here you are, you lose 87 pips. Yeah, that's right, Kenny. U.S. franc against New Zealand dollar had a close to zero correlation or coefficient. So those are the two we're looking at, is U.S. franc and New Zealand dollar. There's many others, but this one should be the most clear, as you're going to see in this example. So we lose, like I say, you lose on this trade. Let's say you sold at the bottom of this candle pretty much and got out at the top. You lose 85 pips. Now, on this trade, at the same exact time, you'd be up about 72. So you'd be still down a little bit between the two. But look what happened. The market kept going. So if you're able to ride this out till it flattened out, you're up 121 pips. Whereas the other trade, you only lost 87 or whatever, you're up 30 or 40 pips. And even if you held these together all the way to here, you're even better off, right? Because now you only lost 50 and you made 130. You see how those work well together? So if you were wrong on one, the other made it up. That's kind of what you want with your strategy. Is you want your when you're trading with correlation, you want to be able to trade pairs that are going to complement each other, not just lose on both. I mean, of course, you could have done poorly here and been on the wrong side. I mean, you may have bought here and you might have lost on both. You're never going to avoid that. But long term, this will be a better choice because you're not just doubling your risk on the trade statistically. I mean, according to those tables, it tells you for sure you're doubling your risk on the trade if you trade it like I showed you on the charts a minute ago. Oh, I must have been saying euro dollar. Okay. Yeah, I meant New Zealand dollar and up here U.S. franc. I might have said the wrong pair. Okay, so we could look in. There's many different scenarios in this little snapshot here. Maybe I should have zoomed in a little bit too, if you guys can't see it very well. Okay, but if you could look right here, I mean, look what's going on here. You've got the market pretty much flat on New Zealand dollar, and U.S. franc was moving up and then moving down. There was movement here, and so it would have been fine to be in both of these trades because they're not really affecting each other You know, if you're wrong on one, there's a good chance you're probably right on the other. So, anyways, that's the basics now. I've kind of used it as more of a filter, and when you've got two signals and you're trying to decide which one to trade, which ones to trade together, just take a quick glance over at this correlation table. You know, and a lot of times you don't have to look at this for every single trade. You can get the idea for the day, and then the whole day you could probably use those numbers. So, you know, especially if you're not trying to get in and out of trades and scalp really quick, you know, you should be able to come on, you know, look at the hourly and daily, find out where things are at for the day, and then just take a mental note of it or write it down so you can, when you're watching your signals come up, if you've got a euro-dollar signal and a U.S. franc signal at the same time, you know, pick the best one. Don't trade them both. If you've got a euro-dollar and, let's see, euro-pound, you wouldn't want to trade those at the same time. So it's really simple, it's pretty straightforward. If you guys have questions, just type them in. We've had a few questions so far, but and yes, we do record these, and we post them on the same page where you sign up, and we do send out an email with the replay. So you can definitely review everything. I'm going to show you guys a little bit more here. I want to show you some actual strategies you can use with correlation as well. There are some things you can do to profit from short-term fluctuations in correlation. So let me show you a strategy here. Let's go ahead and let's use this euro dollar and U.S. franc, this one that's just such a high correlation, negative correlation, that you know they should always move opposite directions, right? I'm going to show you how you can find those inconsistencies and actually trade them, and that's times you could trade them at the same time to make a profit. Okay, so let's see. Yeah, I'm not sure why it would say 7:30 UK time. The webinars, we always do them at 2 p.m. Eastern. So I'll have to check on that. Okay, so let me jump back over to my chart now. So let's do this first. Let's stay at the table for a second, and let's just go look at the 5-minute. So we want to look at for something that has either a really high or really negative, really low correlation or coefficient, and then we want to go to the 5-minute and see where it's really far off, where it's the opposite. So here we are. We were looking at euro dollar versus U.S. franc. It's negative 99.2. Now if we go to the 5-minute, you can see where it's off. We're at negative 77. It's not a huge difference, you know, but we'll go look at the charts and see if there's some opportunities. I'll show you what to look for. We might look at the euro pound and the euro dollar, because you can see that one is negative 93. It's way far off right now. And up here it's showing that it's 66.3 on the 5-minute. Let's actually use that one. I think that'll be a better example, where there's such a big difference from the hourly to the 5-minute. Okay, so we'd expect euro dollar and euro pound to move opposite directions over the last 2 days. Let's go look at we're going to look at the 5-minute chart and the 15 and compare these two. Yeah, Kenny says UK is 5 hours ahead of Eastern time, so it should be 7 p.m. UK time. Okay, so let me switch over to the chart again here. Okay, so we're going to look at euro dollar. Okay, and we're going to look at that against the euro pound. Okay, so you can see that mirrored image, you know, where they're moving in opposite directions over the last 2 days. We can pretty much see what's going on there. But according to our table here, the 5-minute is saying they're starting to move in the same direction. Right here, 66.3. So they're starting to move in the same direction on the 5-minute. So let me go show you what we can do here. We can go to our 5-minute. It's over the last 50 bars, is 50 periods they're looking at. So that's back to about right here. So I'm going to mark that bar. We'll do that on both charts. Okay, so it's saying they're starting to move in the same direction, which looks like they did both move down. So what we can do, because we know they're supposed to move in opposite directions on the long term, but it's starting to shift back positive on the short term, we want to see which direction they've been moving. And what I like to do is put instead of trying to guess, you can put a moving average on your chart. So let's do this. Let's put a 200 EMA is the long-term moving average I like to use. So we'll stick that on both charts. This one we're not going to be able to see. We're going to have to zoom out a little bit. Okay, do you see what's happening here is the euro pound is in an uptrend and the euro dollar is in a downtrend. But short term, in the last 50 bars, it says they're starting to move in the same direction. So what we want to do is trade these in the direction of their trend until that correlation comes back to negative. So what we could do is we could sell the euro dollar and buy the euro pound. Okay, so now the idea is when they start to go back to negative, we'll be profiting. When they, as they move in the same direction, it's going to help hedge each other and reduce our risk and exposure as it continues to trade positive. But once they start to go back to negative correlation, what it's been doing for the last 2 days, we would be making profit. And that's why we're trading it in the direction of the trend, is we're expecting the trend to continue in order to cause that to happen. But that's, of course, our risk. The system's not perfect. You might have to, you might find your own way of picking the direction you trade these. You might have a strategy that says you think euro dollar is going up, and you've got a strong signal for that. So you might come in here and buy this one, buy the euro, and sell the euro pound. So that's the piece, of course, that's going to make this. It's not some holy grail magic system here, but this is a strategy that works. It makes sense. If correlations are not consistent across the time frames, you can expect that there's an opportunity to profit as it moves back to where it should be. So anyways, that's how we would expect this to play out, is as that we go back to that 5-minute. Let me go back to this correlation table. Okay, so as you can see here, we're looking at the hourly is at -93, where the 5-minute is positive 66. So what we should see, if we're making money on this trade, you'll start to see that it's because this number is dropping. It's falling and heading back towards this negative number off the hourly. Now, some of these pairs, if you don't have that long-term negative or positive correlation, which this one really doesn't, the daily says they're pretty much random, moving from each other. It's not going to be as effective. This one was just the one that had the biggest deviation short term, but the best ones are going to excuse me, are going to be if you have at least a daily, where the daily is matching it as well, where it's negative as well. That's why maybe looking at the euro dollar US franc is always going to be a good one, or the euro dollar US yen even. You can see that one's at -92 daily, -83 hourly, but only -30 on the 5-minute. Maybe you wait more, you wait for that to fluctuate more, but what you can see right over here is just kind of nice. You can see the history, what's been going on too. So they're showing you a snapshot, looks like of about 24 hours here. Let's see, 7-4. Yeah, maybe a little bit more than 24 hours, but they're showing you what's been going on with correlation. You can see how it's gone up close to, close to 100, and then it's come down. They're saying 1, which is, I guess we could say it is based on percentages if you look at this, but it's getting close to 1, getting close to -1, which is 100, -100. And see, those are the peaks where you want to be taking a trade. Do you see how it gets up there and then turns and comes back? And just recently it came off of negative, came just off of negative, close to -100. So it's already been heading back up. Let's actually look at this one on the charts real quick, and then I'll probably take some questions, and we'll start to, summarize some of these things, because it is a little. The strategy part is a little bit confusing. If you get nothing else out of this training today, use the basic approach just for filtering, taking 2 pairs at the same time that are correlated or negatively correlated. If you don't use this strategy, that's fine. This is just another way to use correlation as either a confirmation for your trades or a strategy all by itself if you grasp all of this. But let's do this. Let's look at the euro-dollar against the US yen. So let's see, US yen right here. Okay, there you can see how they are. I'm on the 5-minute chart here, and they're moving in a mirror pattern. Okay, which we know if we look at the hourly, that shows us, that's what we'd expect. It's not perfect. It's a little bit lower than we like, but -83 would cause this, would cause them to move opposite of each other. And what's happened, though, is if we look at this little chart, it says just not too long ago, looks like maybe about just a few hours ago, it was very negatively correlated and starting to move up. So if we look at that now, let's go to about the last hour and see if they're still moving opposite, because that's where it's showing that things are starting to come back to normal. Okay, if you look at that, well, this one is pretty much neutral from that bar's close. It's moved nowhere, whereas this one has moved up. So see how there's a difference? This one's moved up about 10 pips. This one's moved nowhere in that last hour. That's why it's starting to change back. It's no longer negative. It's no longer negative, negative 99 or whatever it was at not too long ago. Right here. Is because now they're not moving opposite. If they were, euro-dollar should have went down 10 pips while this one went up, right? So this is where we would have been able to trade to make a profit. Okay, we would have been right here. So we would have seen this thing at the bottom, really highly negative. Actually, we'd look for positive. We'd be right here. So about 8 hours ago, really highly positive where it should be negative. So let's back up and go look at what that would look like. Okay, so let's go back about right in here. Okay. Now you can see this one has moved in that whole period up 102 pips, where this one has only moved down 51 pips. So do you see what you would have been doing here? You would be buying US yen and selling euro-dollar, and as those came back off of that top and started heading down, when it gets right here, that's when you're making money. So just about an hour ago. And right there, if you closed both trades, like I say, you've been selling here, buying here. So really, it's like a hedge. Like we say, you don't trade them that way normally, because you see what happens is when this one moves up and this one moves down, it could have went the other way too, but you're doubling your risk, like I've said before. Actually, I've showed you this wrong. This actually should be a buy. Hopefully I didn't confuse anybody here. Let me go over this one more time. So yeah, you're trading them at the same direction, which tells you, like I've told you earlier, you don't normally wouldn't want to do that on negatively correlated pairs because you're going to lose on one and win on the other and hedge. Okay, so the difference here is at that time the short-term negative correlation or short-term correlation was highly positive when it should have been negative. We're about right in here at that time. So we know by doing this, this is going to change back where it should be, and that's when we're going to make profit about 8 hours later. And you can see what happened. We bought there, we lost 50 pips. We bought here, and we made 108. So we make a 50 pip profit between the two. Does that make sense to see how that kind of works? It is a confusing strategy. I wish there was an easier way. There's some other things you can do, but this has been the best way I've seen it used. And you're playing the inconsistencies in the short term versus the long term. So always be careful with any strategy. This is like, again, I want to say it always looks really good at first when you see it on the charts, but it's not a perfect system. It's no better than any other technical strategies. It's not better than Momentics, and you might have other strategies that are better too. But it's just another tool that you can add that you can be looking out for. Maybe maybe you did get a signal from your system to trade both these. So maybe this is one of those times when your strategy said buy euro and buy the US yen, but you're normally thinking, well, that hourly is saying that they are negatively correlated, so I should stay away from it, right? You'd be thinking, based on what we're showing here today, you'd normally stay away. Well, in this case, if you took it one more step further, you could see, oh, well, the 5-minute, at that time we'd be looking at, we'd be looking at it right there. At that time, it was way positive, so you'd be like, well, wow, there's a big inconsistency here, so I'm going to follow my strategy, knowing that they're probably going to work together. You're helping reduce exposure that you're just wrong on one of them, and you can end up, increasing your probability on the trade, probability of winning on the trade. So it looks like some of you are looking like you like what we've shown you here so far. So, well, I guess I shouldn't say so far. That's pretty much everything I wanted to show you guys. Showed you how it works, how the table works. If you're just going to use it as a way of saying, okay, make sure I don't trade these two at the same time right now, because anything that's really high or really low number, you don't want to trade them at the same time. That alone, like I say, could save you a lot. Because I see it all the time. I see traders, they get into a euro trade, and then 5 minutes later they've got another signal on the US franc, they jump on that one, and then they lose both trades. And that's, it kind of sucks to have two losing trades when you could have avoided the second one and just had one losing trade. So that, like I say, if you just use it for that, I think that'll help you a lot. If you take it this next step and use this as a strategy as well, it's going to take some practice to get the hang of it. So you're going to want to review this recording once we put it up, and do some of these tests for yourself over the weekend. You just come in here, it's kind of hard to see their chart, but you come and look at some of these. Just go in and say, okay, you got US franc versus pound yen, -91 on the hourly, and then you can see above it's positive 48, and you can see on that chart how it just recently was down negative, and that was you can barely see it, but it says it was today at 8 a.m. So that's when you go to your chart and do what I just did, and try to see what happened, see what caused that, and see what your strategy would have been, and just do a little bit of manual backtesting sort of here, just to get a feel for how it works, and then play with it on a demo and maybe start to implement it. There's other strategies that are simpler, and that's some of that we're going to talk about next week. where you can just break these into individual currencies and kind of like how currency strength indicators and systems work. And I'll show you some of that next week. And I think that'll, that one might be a simpler strategy than this. But at least give this a try. Just spend a little bit of time today or over the weekend and see if you can find a way for it to fit into your trading plan. So I'm going to go ahead and close things up. If you guys have a few questions, I can answer those. Otherwise, we're going to wrap it up, and we actually have our beta webinar we rescheduled for today, so we're going to jump into that here in a bit. So, but I do have some time for some questions. And if those of you are still looking, if you don't know where you can find this website for correlation table, the correlation table, you don't have to try to type in this crazy URL. Just go to our blog, TradeWestForex.com/blog, and if you're doing this later down the road when we've made more posts on the blog, just type in the search. Just type in correlation in the search box here. But right now it's the topmost post, and if you scroll down you'll see correlation table, and that's the link to that page. So you can always refer back to our blog if you can't find it. And there's even that quick summary. So a lot of what I've talked about is summarized in this post. So if you kind of forget some things or you didn't take notes today, you can refer back to this short little post and refresh your memory. Okay, we do have a question about our basic entry indicator, basic trend entry indicator. I'd have to check the video. I don't know. I know we've made changes. A lot of times we'll record the videos, and then we have some updates that we make, and I know that can kind of throw things off a little bit. So Richard, you could, if you want to go onto our live chat, we can probably help you. Just verify if everything looks right and help you accomplish what you're looking for there. On the correlation table, are the time frames fixed or can they be customized? For example, can we create a 15-minute correlation? Actually, I haven't tried that before on here. Let me see. They have some other buttons in here, advanced correlation. Let me see if they open that kind of thing up here. That's just going to be more charting, which this is something I haven't seen before, I haven't played with. You're probably not going to really need the 15-minute. Like I say, you can trade the 15-minute chart and look at the 5-minute correlation. What you can do is just change the number of periods. That might be a way of kind of doing the same thing here. For example, if you wanted a 15-minute, well, the 5-minute is based on 50 periods. So how would you get a 15-minute? You would just divide the periods by 3 and then look at that 5 minutes still. So you could put that at about 17. Put that at 17 periods, and now looking at the 5 is more like a 15 period. Does that make sense? Let me make sure I've done that right here. You might have to go the other way. I think we might need to go 3 times the size. Sorry about that. So take that back. If you wanted a 15-minute, same type of thing here, you would need to multiply this by 3, of course, because we need more periods to look at. If the 5-minute on 50 periods is what we're looking at here, to get a 15, we can just bump that to 150, and that pushes us back 3 times further. So that's what I would do if you really want something that's kind of more based on what a 15-minute chart, 50 periods would look like. That's what you could do. So hopefully that makes sense, even though I kind of went the wrong way at first. the way I went would be more like looking towards a 1 minute, really looking really short term. So anyways, 150 will get you about what a 15-minute table would look like. But it's really not designed where you go on your 5-minute chart or a 15-minute chart and you need to have a 15-minute table. It doesn't necessarily have to be used that way. Even the way I was showing you today is more of a, they're independent. I'm mainly looking at it as I know this is based on about 2 days and this is based on the last couple hours. And so you can tweak that however you like. If you're taking really short-term trades, you might drop that number quite a bit. You might want to see just in the last hour what things have looked like and then drop it down to the last 10 minutes and get really short-term fluctuations. Pick up, if you're just looking to pick up a few pips on these differences, these short-term differences, where maybe in the last hour it's really positive, and in the last 10 minutes it's really negative. So you could trade it back to neutral. Any other questions? And remember too, if right now maybe you don't have a lot of questions because you haven't got a chance to try it out for yourself, that's when most of the time the confusion kicks in. So if you guys get it on your charts, you start playing with it, and you need something clarified, you can jump on our live chat or send us an email through the chat, and we can help you at any point with clarifying some of these things. Well, I'm going to go ahead and close things up. So thanks everybody for coming to the webinar today. We'll let you know next week. I think we're going to probably talk about kind of just the next direction from this, which is breaking individual currencies out and look at them compared to each other. More of a currency strength approach. So we'll be doing that next week. So keep an eye out in your email for the blog post, and you should get the webinar invite as well. So hope everybody has a great weekend, and we will see you guys next week.